As we approach the end of the year, tax planning becomes more and more important. Tax planning is the art of looking into the future and trying to make decisions that lower your lifetime tax bill. The analogy that I like to use is that tax planning is looking through the windshield, while tax prep and what you usually do in TurboTax or with your CPA is looking in the rearview mirror at what happened last year. This is something that doesn't really come naturally to most people because it can become very complicated very quickly. Most people have a tax preparer, maybe a CPA that might use TurboTax to file their taxes, and the focus is always on lowering your taxable income that year. So it doesn't really come naturally to be thinking in a tax planning forward-looking context. Today, we are going to talk about the top 5 tax planning opportunities that you might have before the end of the year. I will say before we get into this, it's important to always talk with your CPA, your tax preparer, your financial advisor, any other advisors in your life before implementing any of these decisions. I don't know your circumstances, so things may or may not apply to you. These strategies have the ability to reduce your lifetime tax bill, which should be your goal, not just your taxable income this year. So let's get into it. Number 1 is estimated taxes and withholdings. So everyone that has a W-2 job has tax withholdings. The basis of any tax analysis should aim to get that withholding within about $500, maybe to $1,000 within a refund or a payment. We don't want a big refund or a big payment at the end of the year. If you have a huge refund, that means you loan money to the IRS, you gave them an interest-free loan. And if you have a big payment, that means you underpay the IRS throughout the year, and you may be subject to underpayment penalties. So we don't want either of those in a perfect world. Everyone has their preference. People that like big refunds at tax time will beef up their withholdings. People that like to not give the IRS their money before they have to will dumb down their withholdings. So it's up to you kind of what you want to do there. But what we want to do is go estimate our tax bill for the year using TurboTax or any number of online tools and go see how much we're going to have in withholdings. So we take our pay stub, we see how much we've withheld so far this year. We can do the math and kind of know where we're going to end up for the year and compare that to our tax bill. If you're going to be short on taxes, you can increase withholdings as well as make an estimated payment directly to the IRS or your state government. Estimated payments are typically only for those who have irregular income or are self-employed. So those are entrepreneurs, those who have stock options, bonuses, things of that nature, large amounts of cash coming in that isn't necessarily taxed like your paycheck may be. Those who are normal W-2 workers, that their income isn't changing much year to year, or their tax situation in terms of dependence or marriage, are typically not going to have to adjust their withholdings much if they didn't have any problems last year at tax time. Number 2 is capital gains and loss harvesting. So this is for those who have taxable brokerage accounts or taxable investments. So these are people that don't have, they might have an IRA or a 401k or a TSP, but when we're talking about loss or gain harvesting, this is in a taxable account, a brokerage account typically. So this is the practice of intentionally selling a position that you own at a taxable loss and replacing it with another security so we can maintain the integrity of that account and realize that capital loss. Those long-term capital losses can be put against ordinary income up to $3,000 under current tax law. So it's a pretty good strategy to be able to take advantage of a capital loss and apply it to an ordinary income rate that can be typically much higher than capital gains tax rates. You have to be careful not to run afoul of the IRS wash sale rule, and you have to be careful not to buy a substantially similar security. That is the vague term by the IRS, but you have to be careful and talk to your tax preparer, talk to your CPA, your financial planner. But this is typically beneficial more for those who are in that high tax bracket compared to their lifetime. They can take advantage of that $3,000 loss against their ordinary income, as well as additional losses against any capital gains they have, and carry those losses forward to future years. On the flip side, capital gains harvesting is for those who are in inordinately low tax brackets for their lifetime. This is the ability to sell a security at a gain and just buy that security back again so you can maintain the integrity of that portfolio and step up that basis to the value on the current day. This allows you to realize capital gains at potentially a 0% capital gains rate, the best rate in all of taxes. In 2023, that's anybody with less than $44,626 for single or $89,521 for married filing jointly of taxable income for that year. You could be in a low tax bracket this year for all kinds of reasons. And an example that's very applicable to military is a brand new second lieutenant. Their taxable income for that year is very low due to just commissioning, and they have all that BAH and BAS that's tax-free. Typically, they're going to be in that 0% capital gains tax bracket. So if they have taxable income, any taxable brokerage accounts, they can potentially realize that at a 0% tax rate. Another reason might be you could just be a college student. You could be taking a sabbatical. You could be an early retiree and you haven't started drawing on that pension, Social Security income, whatever it may be. This is a very simple strategy because it involves just realizing that capital gain and buying the same stock right back again. You don't have to change anything, and you just get to step up your basis and take that gain at the best rate in all of taxes, which is 0%. Number 3 is Roth conversions. This is for those that have money in a traditional 401k or traditional IRA, and we can convert that money to a Roth account. This involves converting a portion of that account, which is pre-tax money, over to a Roth IRA. In that year, we will then pay taxes on that income because when we initially contributed to that traditional account, we got a tax break, and now the IRS wants their money because we're converting that over to a Roth account. This usually makes sense for those who are in a lower tax bracket this year than they anticipate being in the future. So this could be those who retire early, those who take a year or two off of work, they're on sabbatical, whatever it may be. If we have pre-tax assets in traditional accounts and our income drops for that year, Roth conversions become very, very appealing. It's also good to have tax diversity in your retirement income. We don't want everything in traditional. So you have the option to take out tax-free money for a Roth IRA and don't always have to pull from those traditional assets. For example, if you're in retirement and you're taking out $5,000 a month from a traditional IRA or 401k, and you want to take your whole family on vacation for $30,000, you are going to want to pull that out of a Roth account if possible, because if you're taking that out of a traditional account, it's going to drive up that taxable income potentially into the next tax bracket. And when you take it from a Roth account, there's going to be no tax effects. So having that optionality when you can choose when to use Roth in traditional and retirement gives you tons of options going forward to make sure you pay the lowest amount in tax over your lifetime. Lastly, it can make sense to consider a Roth conversion if the market has declined substantially. You can then convert more shares of stocks and bonds per dollar of tax if the value of the accounts that you own are down. Number 4, retirement plan and HSA contributions. So for those who want to put away money for retirement, we want to drive down, but also want to drive down their taxable income for the year as well. Traditional IRA contributions will drive down your taxable income for the current year and will be taxable when they're distributed in retirement. Health savings accounts, or HSAs, are for those who are in a high deductible health plan. This is not those who are in TRICARE, so military families aren't eligible. But for those who are eligible for an HSA and can use them, contributions to these accounts are tax deductible on the way in. They grow tax-free, and they're tax-free when taken out and spent on qualified health expenses. This is commonly referred to as the holy grail of retirement savings vehicles because of that triple tax savings. Unfortunately, the HSA is not for everyone. It's only for those who are on those high deductible health plans and are eligible for these types of accounts. Lastly, for business owners, you might be eligible for a SEP IRA or a solo 401k. Depending on how your business is structured, this will allow you to contribute large amounts of money at once to lower your taxable income for that year. If you're in a high tax year for yourself, you're going to be able to diversify away from your business as well as lower that tax bill. So this can be a huge win for business owners that are in high tax situations, high tax states, or have a high income year. Finally, the 5th strategy is charitable donations for those who are charitably inclined. Qualified charitable distributions as well as donor advised funds can be extremely beneficial from a tax perspective. One caveat is that you really have to be charitably inclined for these strategies to pay off. Donating $1 to get 20 cents of a tax break is not a winning strategy for somebody who's not willing to donate and not already donating. Due to the 2017 Tax Cuts and Jobs Act, the standard deduction makes sense for most people. This is because the standard deduction got doubled. So in 2023, it's $13,850 for single and $27,700 for joint filers. So in order to get over that limit, you would have to have itemized deductions to make it worth it that you're taking those itemized deductions of more than those amounts instead of that standard deduction. So to get over that limit, one strategy is a donor advised fund, which allows you to make large contributions in one year and get the tax break for that year. The money can then be invested in a investment account in whatever you want, and then distributed however you want in future years. And you've already taken that tax break, so you can let that money sit there and compound and then give to charities that you're passionate about in future years. This is an outstanding way for someone who's charitably inclined and needs to bring down taxable income for an inordinately high earning year. Maybe you sold a business, you sold a house, you had dual incomes for a year, whatever it may be. There could be any number of reasons that your income is high in one year. And you want to take advantage of the tax deductions that come with being charitably inclined and use a donor advised fund. The other strategy for those who are withdrawing from the traditional IRAs and are also charitably inclined are qualified charitable distributions. So the IRS requires a certain amount to be distributed each and every year, which is called a required minimum distribution, or RMD. Instead of taking a distribution and paying tax on that, someone can take all or a portion of that distribution and donate it directly to a charity. For someone who's not giving money to any charity, this won't make a ton of sense because they're going to be worse off. They'll need to replace that income. But for charitably inclined people who don't need that RMD and who are already giving money to charity, this will be an absolute home run as they get to satisfy those RMD requirements. And then that money essentially bypasses the IRS and goes straight to the charity of their choice. So check with your IRA provider on the best way to execute a QCD, as every provider is a little bit different. So to wrap up, the top 5 tax planning considerations to think about before the end of the year are estimated taxes and withholdings, capital gains and loss harvesting, Roth conversions, retirement plan and HSA contributions, and charitable donations with donor advised funds and qualified charitable distributions. Tax planning is the art of looking through the windshield, not that rearview mirror. Our society focuses so heavily on lowering your tax bill in this current year and not enough on looking at that forward-looking tax planning into the next 10, 15, 20 years and making sure we're trying to lower that lifetime tax bill. So by being proactive and looking at where you are now and where you might go in the future and what tax rates might be for your family, hopefully you're able to use some of these strategies to lower your lifetime tax bill.